Big moves are shaking up the markets right now, and you need to be the first to know about them. World Investment Advisors is making major waves in the tech sector by aggressively increasing its holdings in Qualcomm Incorporated. This firm just snapped up over 8,000 additional shares in a move that signals serious confidence in the wireless giant. It is a massive play that has investors buzzing about what comes next for this semiconductor powerhouse.
Looking for a fast-charging, ultra-responsive stylus for your iPad? Meet the 2X Fast Charge Active Stylus Pen, designed for 2018 to 2025 Apple iPads. Take your creativity and productivity to the next level. Click the link in the video description to shop now on Amazon.
The action around Qualcomm Incorporated is not slowing down as the stock price just gapped up significantly before the opening bell. Investors were stunned to see shares jump from the previous close of under $134 to over $145 in a single session. This surge has fueled intense debates among analysts about whether this represents a true breakout or just another volatile swing in the market. The race for the future of artificial intelligence is heating up, and Qualcomm Incorporated is being thrust into the spotlight as a potential trillion-dollar contender. While global giants like Amazon and Tesla dominate the headlines with massive projections for humanoid robots and generative technology, smart money is looking for the hidden innovators behind the scenes. Analysts are now pointing to companies like this one as the critical backbone that could enable a massive $250 trillion revolution. It is a wild ride for Qualcomm Incorporated as the stock surged 11% following blowout earnings from Intel. Even with this boost, the company still faces hurdles like the Apple modem threat and slow growth in the China smartphone market ahead of their own upcoming earnings report. Stay on the pulse of every market shift by hitting that like button and smashing the subscribe bell to stay ahead of the curve. Is Qualcomm on the verge of a breakthrough or stuck in neutral? Welcome back to the channel. Today, we are breaking down the latest moves surrounding tech giant Qualcomm, and it is a mixed bag of institutional activity, insider selling, and some very lukewarm analyst sentiment. First off, World Investment Advisors has been busy. They just upped their stake in QCOM by over 14%, now holding nearly 65,000 shares worth over $11 million. They are not the only ones. Institutional interest remains massive, with over 74% of the stock locked up by big money players. But here is the kicker. While those big funds are loading up, the analysts seem genuinely conflicted. We are looking at a consensus hold rating right now, with firms like Morgan Stanley and Barclays initiating coverage with underweight ratings and others cutting price targets. Wall Street is clearly hitting the brakes on their enthusiasm. And it is not just the analysts. We have seen some significant insider selling lately, with EVPs offloading thousands of shares recently. Now, to be fair, Qualcomm did crush its latest earnings expectations, beating estimates by 12 cents a share and showing solid growth, but the market seems focused on the future. Even with a new $20 billion share repurchase plan authorized by the board, which is usually a massive signal of confidence, the stock is hovering well below its 200-day moving average. So, where does this leave you? Is it a value play waiting to happen, or is the hold rating the smartest move in the room? If you want to dive deeper into the hedge fund data or see which stocks top analysts are actually whispering about, check the links in our description. Remember, a dividend yield of 2.7% is nice, but always do your own research before jumping into a volatile tech play. Do you think Qualcomm is undervalued, or is the best of this cycle already behind us? Drop a comment below, and let's get the conversation started. Don't forget to subscribe for more straight talk analysis on the stocks that matter. Is Qualcomm at a turning point, or just hitting a wall? Shares of the tech giant gapped up from $133.95 to open at over $145 recently, signaling a major jolt of energy in the market with over 7.6 million shares flying off the books. But behind the price action, the story gets complicated. Analysts are all over the map on this one. You've got firms like Seaport Research and Barclays slapping sell or underweight ratings on the stock, while others remain cautious. Currently, the consensus is a lukewarm hold. But here's the interesting part. While the analysts are debating the future, the company's fundamentals are showing some real muscle. They just beat earnings expectations, posting $3.50 per share, and revenue is steadily climbing. Add to that a boosted dividend and a massive $20 billion stock buyback plan, which is usually management's way of saying, "We think this stock is undervalued, and you have a company trying to prove the skeptics wrong." Now it's not all sunshine. We are seeing some notable insider selling, with key executives trimming their positions. But on the flip side, institutional heavyweights and hedge funds have been quietly increasing their stakes, which suggests the smart money might be betting on long-term stability rather than short-term noise. So what's the bottom line? Qualcomm remains a cornerstone of the global semiconductor world, from Snapdragon chips to the future of 5G and beyond. With a solid debt-to-equity ratio and a clear vision for 2026, they are certainly not going anywhere. But as always, the market is a fickle beast. Are you holding, selling, or waiting for a dip? Drop a comment below and let me know your take. And if you're looking for where the next big move might be, check out our report on the 5 stocks top analysts are currently whispering about. It might just change your portfolio strategy. Don't forget to subscribe for more deep dives into the stocks moving the market. What if I told you the next trillion-dollar breakthrough isn't just another flashy software update, but a massive shift that could turn $250 quadrillion into the new standard for the global economy? When Jeff Bezos hinted that one single technology would define Amazon's future, most people didn't grasp the scale. Today, Amazon's CEO, Andy Jassy, calls generative AI a once-in-a-lifetime pivot point. But the real headline grabber is Elon Musk, who recently predicted a future with 10 billion humanoid robots roaming the Earth, each priced at a fraction of a luxury car. If he's right, we're looking at a $250 trillion industry by 2040. That is a number so large it's almost impossible to visualize, yet major firms like McKinsey and PwC agree. The AI revolution is just getting started. But here is the secret Wall Street hasn't fully digested yet. The true engine of this growth isn't just the household names we see on the news every day. While everyone is fighting over Nvidia and Microsoft, a quieter, under-the-radar player is building the literal architecture that makes this entire AI ecosystem possible. This company's technology is super efficient, cost-effective, and arguably the biggest threat to the industry's status quo. Why does this matter to you? Because the wealthiest investors in Silicon Valley are quietly shifting their positions as we speak. I've put together a deep dive report that reveals exactly who this company is and why it could be the most important ticker in your portfolio. You can get full access to this report, along with an entire year of premium market insights, our monthly stock picks, and exclusive, ad-free research for less than the cost of a fast food meal, just $9.99 a month. We're so confident in this research that we're backing it with a 30-day, no-questions-asked money-back guarantee. Space is strictly limited to 1,000 spots for this special access, and you don't want to be the investor reading about this 6 months from now when the entry price has already skyrocketed. Head to our website, lock in your subscription, and secure your seat at the table of the next great wealth transfer. The future is being written right now. The only question is whether you'll be a part of it. Ever feel like the market is giving you a gift, only to hide the price tag in the fine print? That is exactly what is happening with Qualcomm right now. Shares just exploded 11% in a single day, leaving investors cheering, but if you zoom out just a little bit, you will see a much more complicated reality. The stock is still nursing a 13% loss for the year. So, what is really going on? First, let's give credit where it is due. This rally wasn't actually about Qualcomm. It was a massive wave of euphoria triggered by Intel's blowout Q1 results. Intel soared 25%, effectively killing the CPUs are dead narrative and dragging the entire semiconductor sector into the stratosphere. For Qualcomm, this provided the perfect fuel for a classic short squeeze, pushing the stock back above its critical 50-day moving average. It is a win for the bulls, but it is a fragile one. Why the lingering year-to-date weakness? It comes down to 3 massive shadows hanging over the company. Apple is steadily moving toward its own C1 modem technology, putting Qualcomm's most lucrative relationship on a timer. Then there is the sluggishness of the China smartphone market, where MediaTek is playing hardball, and the reality that their Snapdragon X Elite PC launch hasn't been the instant silver bullet investors were promised. When you see revenue rising, but operating income slipping, you know margins are under fire. But don't write them off just yet. Qualcomm is aggressively diversifying, with automotive and IoT revenue segments hitting over $1 billion each. They are pushing hard into data center silicon, trying to prove they are more than just a phone chip company. The market has priced them at a modest 12x forward PE, which suggests that the trouble is already baked into the cake. Next Wednesday, April 29th, is the real test. Polymarket is pricing in a 93% chance of an earnings beat, meaning the expectations are sky high. If management can deliver a clean report and calm fears about that looming Apple revenue cliff, this bounce could finally turn into a genuine trend. If not, today's rally might just be a temporary reprieve. Are you buying the dip, or is the Apple threat too much to ignore? Drop a comment below with your take, and make sure to subscribe so you don't miss our breakdown of next week's earnings report. Remember, in this market, the trend is your friend, until it suddenly isn't.